Hey, there's this quiet trend that a lot of successful entrepreneurs have found that has allowed them to shift their income from active and managed over to a more passive approach. Now, regardless of where you are on the entrepreneurial spectrum, whether you're a tech startup founder, whether you're a seasoned entrepreneur, whether you're just getting started, real estate is actually a really powerful and stable end game for a lot of entrepreneurs. So today we want to dive into why a lot of savvy business owners and entrepreneurs are turning to real estate as their ultimate long-term wealth building strategy. So stick around. This episode of Own the Exit is all about changing the trajectory of your entrepreneurial journey and end game, and how real estate could and maybe should be a part of that.
What's up, everyone? Thanks for joining us for another episode of Own the Exit. How's it going, Caleb?
What's up, Aaron? Man, it's going good.
It's good to see you again.
Fall is back in Kansas City today.
October crept up on us.
It's in the
I have to wear
70s.
my sweater today.
It's so nice.
I love it.
Yeah. We're in the studio today, but I would just as soon be outside.
Exactly. Yeah. Cool. Hey, man, today we're going to talk about real estate. And this is something we talk about a lot on this podcast. We're both real estate investors. But specifically, how do you feel that real estate factors into an entrepreneur's journey? Someone who has businesses, is growing their wealth. I feel that real estate can be a very important piece in wealth building.
100%.
And what are your thoughts on that?
Yeah, I think that real estate is absolutely, it's been, for me personally, has been an absolute game changer. Just even through, I've talked about the things that my family went through several years ago and how I lost a bunch of money in the stock market and stuff like that because I took my hands off the wheel and was so active. Mm-hmm. And when my son had a stroke at 9 months old, and the only thing financially that was working for me when I wasn't able to work it was my real estate. Mm-hmm. That income was there. That value was there. It didn't fluctuate based on my hands being able to be constantly at the wheel. And that was a real wake-up call and awakening for me that I wasn't heavily enough allocated into real estate. I had some real estate, but more of my money was in paper assets. Mm-hmm. And I really think that a lot of entrepreneurs are shooting themselves in the foot by being afraid to go more heavily into real estate. That's just my thought about it.
Yeah, that's a good point. I'm just thinking about this house I bought, and I haven't really done anything. I've actually owned it for 20 years. Yeah. And the house has gone up hundreds of thousands of dollars in value with me doing nothing really. Yeah. I think I replaced a sewer line 8 years ago and just called the guy and he did it. It's relatively passive. And then meanwhile, I have businesses where I'm working as hard as I can all day, trying to get the cash flow, trying to grow it. And then you look over here and then the piece of real estate that I'm just not doing anything with is going up in value hundreds of thousands of dollars. Yeah. And so it's something that's working behind the scenes that can supplement or be, like you said, it's that wealth building. Maybe there's not a lot of cash flow on real estate. There's just not, compared to going out and getting like a business where you're actively growing the cash. Yeah. But it has those wealth building qualities that I think are just almost turnkey and not guaranteed, but very proven.
And that's one thing one thing that I think entrepreneurs have been sold a bill of goods on that just is not. It's not the right mindset to think about it, is when you think about real estate as an investment compared to almost any other investment other than investing in your actively managed business. Number one goal is never cash flow. You invest in the stock market, you're not getting cash flow from owning Tesla stock. You're getting growth of value, or at least you hope that you will. You hope that Elon won't drop another tweet that cuts the value in half, right? Or whatever it is. And I love Elon, so I'm just saying the fact of the matter is there's so many different things that can manipulate the value of that. But why is it that entrepreneurs, when they think about investing in real estate, they're like, oh, I've got to get cash flow like today. I've got to get like huge amounts of cash flow. People want to invest. I want to invest $100,000 and I want to get $100,000 a year in cash flow from real estate. And it's like being passive. It's what dream world are you living in that you think investing means immediate income? Mm-hmm. It's about long-term wealth generation and growth. And if you're able to shift that mindset as an investor to where you're not focused so much on how much money can I make today on this, go work your business. Yeah. You're in your 30s, you're in your 40s, you're in your 50s. You're still able to actively earn income and take care of your family. Go do that. Right. What are you going to do if you don't? You're just going to sit on a beach? And die early probably because you don't feel like you have a sense of purpose or anything. Go to work, make money, be diligent. I'm a firm believer in the book of Proverbs that talks about consider the ant. Like nobody has to tell that ant to go to work. It just does it because there's a natural built-in diligence that says if I don't do this, then I'm not going to eat. So go to work, then build wealth through investments. Don't focus on investments being and this is sorry, I'm getting on a soapbox and I'm pretty passionate about this because I see entrepreneurs missing the opportunity all the time because they're so focused on like right now. And I get it. Like in your business, the focus is a lot of times has to be right now.
Yeah, there's people. I was just talking to somebody this week. They're making hundreds of thousands of dollars in cash flow, and there's no purpose.
Yeah.
They're like, it's not unto anything.
Exactly.
They're like, hey, it's awesome right now, but this completely requires my engagement daily.
Yeah.
I can't get out of it. I can't really sell it in this particular case. And so he's looking about like, how can I take that cash flow and then put it into something that will multiply and grow in value. That wealth,
versus in 10, 15, 20 years from now.
Yeah, 100%.
Be worth 3, 4, 5x or more. So yeah, it's not a new topic on the podcast. We're talking about real estate here. I think thinking a little bit about why real estate specifically does appeal to entrepreneurs, because we're talking about so far talking a little bit about why entrepreneurs maybe are a lot of times think about real estate the wrong way, but they're still thinking about it, right? So the idea is the reason why I think it does appeal to entrepreneurs, and it's one of the reasons why we're doing this episode, is to try to help entrepreneurs think about real estate in the right way, because they're already thinking about it, right? But think about it in the right way. And I think one of the reasons it appeals to entrepreneurs is because real estate is a tangible asset, right? It's anchored in a real thing.
Yeah.
And most other investments, whether it's crypto, that's anchored in a digital asset, it's code in a server somewhere. It's not even tangible in the sense of it being a paper asset. It's just and I'm not saying there's not value, you can't make money there. Like I'm not knocking crypto at all. Yeah. I do think it's a lot easier to get scammed in crypto than it is in real estate, but whether it's crypto or whether it's stocks or bonds or any of that kind of stuff, those are all paper assets. And I mentioned before, I spent about 5 years swing trading actively in the stock market, trading paper assets. The biggest thing that I learned way early on in that was there are so many different things that large institutional banks and something like 10 banks control like over 60% of U.S. gross domestic product. And so these institutions, these large banks, they have huge amounts of money that it's actually your money. You're the one that deposits it with them, right? They give you 1% or a tenth of a percent on a savings account or whatever it is, and they take that money and they actively trade it in the stock market, and they dump millions of dollars, forcing the value of these paper assets to go up and down. These paper assets are only valued based on public perception. Right? Whatever people think they're worth, that's what they're worth. Whatever people are willing to pay, there's no utility value. And that's the thing I love about real estate. And the reason I think a lot of entrepreneurs like real estate is because it's tangible. Would you agree with that?
Yeah, you can drive by it, you can touch it. If something goes bad, you can go live in it.
Yeah, exactly.
At least you got a roof over your head. And then just the replacement cost of it. For that asset to go down to zero would be just impossible almost.
Impossible.
At least there's the land.
Even if it burns to the ground, the land, they're not making any more land.
Then you get insurance on it.
Yeah, exactly.
You're paying $100 a month for that coverage if something does happen to the value where it gets destroyed or hurt by...
Try getting insurance on your Coca-Cola stock. You know what I mean? If that goes to zero, guess what? You just lost all your money.
Yeah.
And I'm not knocking the stock market. I think a lot of people have made a lot of money in the stock market, so don't hear me saying that. It's just real estate appeals to entrepreneurs because entrepreneurs, I think, are more in the tangible. What can they do to impact? What can they do to help it to grow and increase? And I think entrepreneurs have a unique advantage as real estate investors because they can approach it with that mindset. There's really only three questions you need to answer when investing in any kind of real estate asset, regardless of the method or the way. And we can talk a little bit about the various different ways you can invest in real estate, but there's really only three questions. One, how can I increase the income of this asset? And what's the plan to do that? How can I decrease the expenses? How much does it cost to manage this asset? And then number three is, who are the people that are going to execute plans 1 and 2? Yeah. And that's really... At a baseline, that's any business.
Yeah. I think as you're an entrepreneur too, as you first start growing and being successful in whatever business you're doing, like I've talked to people where as they start to get a lot of income coming in, then it's a good time to look at real estate. Because I've talked to entrepreneurs where it's like, hey, I got $100,000. I don't want to put that into a piece of real estate because I could make way more in my business with that.
Sure.
Multiplying that. And there's that's probably true if your business is successful and if
Yeah.
you're actively working in it. But then it comes to a point where it's like you want to diversify and you want to start putting chunks of cash into those more stable assets and those pieces of real estate that can go up in value and still keep making the cash flow. So I think it's like, it's not either or, it's just being diversified and putting your excess cash into things that maybe don't take a lot of your involvement and can just help buffer that.
I think a lot of entrepreneurs suffer from Superman syndrome, right? They think that they're bulletproof, that nothing bad is going to happen, that worst case scenarios aren't for them, because we are like natively and naturally optimistic as entrepreneurs for the most part. We think about the future through rose-colored glasses, and that's why we're able to impact change in the world and be fearless and actually do things that other people are terrified to do. And I think it's a good problem to have, but but it's a good strength to have, but with every strength comes a corresponding weakness, and that's that sometimes we think, I hear of these kind of horrific things happening to other people, but not to me. It couldn't happen to me, wouldn't happen to me. And the truth is, I thought that way. And then, and not to hammer my personal story, but I experienced tragedy that cost me almost half my net worth. Because everything was dependent upon me and my active involvement. And so I know that's why I'm really passionate about other entrepreneurs hearing and getting this, is you don't want to be in a situation where something that's completely out of your control, completely not your fault, happens to you or your family, and now suddenly your family's financial situation is in jeopardy because it all completely depended upon your ability to be actively engaged and involved. And that ability can be taken away from you. And Murphy's Law says if it can happen, then eventually it probably will. And so I think entrepreneurs really have to think that way. It's don't stop building your business out of fear of bad things happening. Don't give me like build it even more if you're afraid that bad things are going to happen. But also make sure that there are things that don't require you to have your hands at the wheel constantly, day in and day out, managing, actively doing. And that is what real estate is for a lot of entrepreneurs. It's that piece of financial security and freedom that says, you know what, if the worst case scenario happens, real estate is my greatest insurance policy. I know that income is going to be there, that value is going to be there. And it's been that for me. It's been that for you, I know. And it's been that for a lot of entrepreneurs that we've been able to help and work with. But I do feel this idea that real estate is a great wealth building avenue for entrepreneurs. We've really established that in this episode. I think that anybody with half a brain wouldn't disagree with the things that we're talking about, right? But the real estate investing world is really vast, right? There's so many different ways that you can invest in real estate. And I think it's important that we highlight some of those ways in this episode because, as listeners, we want you guys who are tuning in here to not only walk away from this little episode of Own the Exit with a determination and a resolve to say, man, I want to invest more in real estate, but to actually begin the journey of understanding what's the best way for me to get started? What's the best way for me to invest in real estate? And what are some of the types of effective or most common kind of ways to invest in real estate, Aaron?
Yeah, real estate is very vast. I don't think there's a right or wrong way to do it. I think a lot of it comes down to your desires, your skill sets, your time constraints, the amount of money you have. When I started out in real estate, I didn't have any money. So I didn't have the option of being a passive investor in someone else's deal because I didn't have any money. So I had to go and be the guy that created those opportunities and then pulled in people that did have money. And so that's how I started my journey. And for me, I'm in the real estate industry, so I'm active in real estate, raising capital, building or buying huge assets. It's my day job. Just like an entrepreneur who works in a different industry, right? That's my day job, my work. That's where I get my income. And it just so happens to be within real estate. Whereas a lot of entrepreneurs, maybe they have their business in something else, and then the real estate is their other wealth building thing they got over there. And so as far as the best way to do it, I always think that it's good to have experience managing something in like a piece of real estate. Collecting the rents, paying the taxes, getting the mortgage. I think it's a good place to start is just to take those small steps of growing your own real estate portfolio, getting some awareness, starting to understand how it works. And then if you want to hand it off to somebody else, that's awesome. Or if you want to go passive, again, I'm just talking here because I don't think there's a right or wrong way to do it. But for me, I know that my journey has been actively like managing like end to end all the aspects of deals to where I have an understanding of real estate and how that works.
What it takes and the work involved.
Yeah.
And I think that most entrepreneurs are only really aware of that one way of doing it, if you're honest. And it's just do it yourself real estate. Just buy a fourplex. Just buy a single family rental. Just buy an apartment building, right? Just buy it and just manage it and just hire people to manage it and make it become another business. And I agree that
it's a good place to start.
It is a great place to start. But I think understanding that there are other ways to invest in real estate that are not just do it by yourself. If you think about do it yourself real estate, you have 100% control, which is awesome. You also have 100% responsibility, which is not always awesome, right? It's a lot of work. It's a lot of management, but it's a good opportunity to learn and know what it takes to execute on a well-executed real estate investment business plan, right? You do have the ability to sell it whenever you want, but it's not a liquid investment. So a lot of people are afraid to tie up money in real estate because they're like, what happens if the market gets hit and all that kind of stuff and I can't get my money back? It's like your money's better stored in a tangible asset unless you literally need it for food. And then at that point, you probably shouldn't be thinking about investing. You should think about increasing your income so you can make sure that your family has enough food. But so those aren't the people that we're talking to. It's people who would take that. We're talking to people who their situation's secure, right? They're covered. And now it's time to step into real estate. But the other ways that besides just doing it yourself, say you are able to bring a couple pieces to the table, but you can't bring all the pieces to the table, right? You got some capital, maybe a little experience. Somebody else has a little more experience, a little less capital. You could do joint ventures, right? Talk a little bit about joint ventures. And you've done a few of those.
Yeah, I think everyone has limited time, limited resources, limited money. Every single person has limitations on what they can do. And so to your point of I can just go buy a fourplex and start managing and building all this, you can, but then you're taking away those minutes from your other business.
Exactly.
So if you're an entrepreneur who's just crushing it in an industry, I don't know, let's say you have a marketing firm, to deviate from that and to take away your special sauce, right? You're right in your lane. You're legit. Like you did it. But then to break away from that and go and into this new field with the learning curve and something like it, at the end of the day, like you could suffer. It would be better to just keep that focus on that marketing firm and growing and scaling that, because that's where, and there are others like unique people where they can do 3 or 4 things and crush it at all of them.
Yeah.
That's not like, it's rare. And even if you can, it's just exhausting. And so the idea of joint ventures where it's like, hey, maybe I did a joint venture with a guy who we bought an apartment building. He put up all the cash. I'm doing all the work.
Yeah.
We're split at 50-50. And for him, he's out of state. He doesn't have the team. He doesn't have the market knowledge.
Yeah.
He doesn't want to manage it. He doesn't know how. And for me, I'm like, that's what I do on a daily basis. So that works. Joint ventures are awesome.
Yeah.
If you have the right partners.
Right.
Bad partnership I've had basically one bad partnership in my whole entrepreneurial career.
Yeah. That's good. A lot of our listeners are probably like, man, I wish I only had one.
And it wasn't like, it could have been worse.
Yeah.
So I got out relatively unscathed.
Yeah.
But
what are some of the challenges with a joint venture? I think about now you've gone from 100% control to shared control. So that's why it's important to make sure you pick a good partner that has alignment of values and goals for what you're trying to accomplish there. So it's really important to have those conversations probably up front. It would be a way to mitigate that. But at the end of the day, you're not the 100% decision maker, right? You've got 50% of the decision, and you got to get that guy to agree in order to sell it, in order to refinance it, in order to do anything with it. Somebody's got to get the other one to get on their side. And then but the trade-off for that is there is now shared responsibility, right? Which is a good thing, right? You're not having to do or put up all the money and do all the work, or you're not having to bring all the pieces to the pie. You're able to bring your piece, and the other guy or the other 1 or 2 people are able to bring their other pieces. And so I think joint ventures are a good option for people who work better in partnerships or who know there's pieces to the pie that they just don't yet have the skill set or ability to bring, and they need to find someone who can complement that. Now,
and even if you could buy the whole apartment complex yourself, right? Do you want to though? And I think that's another thing of joint ventures is, did I want to come up with $3 million in cash because that's how much money the guy put up? No, I didn't want to figure out how to come up with that.
Yeah.
He already had it, and he didn't want to try to figure out how to find the deal and do this thing for the next 5 years and getting the rents up and all those things. So I think I like joint ventures because you can think bigger. And I think that's like from us entrepreneurs, like we love that because you get to be a visionary now. You're not just constrained by, imagine you were an entrepreneur with no team.
Yeah.
That's what it's like doing real estate solo.
Yeah.
It's like you're just constrained to your own money and time and abilities. And within real estate, that's why I liked syndications, group investing, joint ventures, getting into larger assets, where now you can start taking down more exciting assets, things that have like bigger upside, more like class A apartment complexes or whatever your asset class is, industrial, whatever kind of commercial stuff you're doing. But you can take down exciting things and just have a piece of it. And also only have to be like doing the part of the work or the area of like your expertise or where you fit in.
So I want to talk a little bit about, you mentioned syndications, because I think syndications fly under the radar with a lot of entrepreneurs, or they're misunderstood by a lot of entrepreneurs. The value of a syndication is this, and it's really powerful. It takes the best of do-it-yourself, joint venture, and even REITs, right? Because one thing we didn't touch on is REITs, and I'll hit that real quick before touching syndications, is that REITs are paper assets that are backed by a company, a fund, a trust that then goes out and blindly invests in various different real estate assets and manages the business in that way. And the public perception of the value of that company is what determines the value of that REIT. And so although a REIT is an investment backed by real estate, you never really know what real estate you're investing in. Now, the benefit is that it's liquid. Right? You can buy it and sell it pretty much any time as long as there's a demand for it in their market. And if there's not a demand for it in the market, then that means you lost a bunch of money. And so it's a lot more liquid and things like that. And it's 100% passive, right? You literally just buy it and set it and forget it. But with a syndication, I think it takes the best of the REIT and the best of both worlds of a JV or do-it-yourself type thing, rolls it all into one, because you are able to be a part of a bigger team, a bigger group that's going into a larger asset, meaning that if you're in a joint venture and you're buying a 100-unit apartment building, then somebody's got to bring the $3, $4, $5 million of capital to the table, right? Someone within that JV partnership has to bring all of that money. And so to get into that kind of asset, the kind of asset that really has the ability to scale a real estate portfolio to the point where it can be a wealth building engine for you. It's not just having a couple, 10, 15 rental properties over here that are throwing off a little bit of cash flow and going up in value and are going to be worth some money one day. But you really have the opportunity to achieve economies of scale where you can really build wealth through real estate. But if you do that as a joint venture, which a lot of people have done, and it's great, but then you're talking about putting all your eggs in one asset, right? All your money in one asset, or unless you've just already got tens of millions or hundreds of millions of dollars, you're going to be risking a lot on that one asset.
Right.
And then with the syndication, though, you can get into the same asset, have a little bit smaller ownership percentage, or have a smaller ownership percentage of that asset, but be able to diversify your money across multiple different assets. So it grabs you the best of both worlds in terms of diversification, in terms of passivity, right? You don't have to be actively involved. You can just find really great operators, guys like Aaron, right? Find people like that are able to really manage these assets, have proven it. At OakIQ, for example, and this is not an ad for OakIQ by any means, but I think we do a great job. We've got over 150 million in apartment assets under management, a lot of experience, a lot of full cycle deal experience, a lot of investors that are getting paid distributions that have made a lot of money with us, and they've been passive.
Right.
And so but they were able to look at a specific deal, vet and do due diligence on a specific deal that was bigger than they could have gotten to be a part of on their own by themselves, but they're able to get in and be a part of that and then diversify this, invest $100,000 and get a piece of a $70 million asset. It really is, I think, it flies under the radar. It's one of the most effective ways that an entrepreneur can invest in real estate and still be able to keep their focus on their primary business.
Yeah, no, absolutely. And syndications are actually pretty simple. You need, let's say you're buying an apartment building for $10 million, you get a $7 million loan. You need $3 million for the down payment or whatever the number is.
Yeah.
So you get a group of people together, you come up with the $3 million. There's some fees on it for asset managing and everything for the sponsor team. But then when you sell it, you give all the money back to investors, the $3 million. And then if you make $3 million in profit, most of that goes back to them too.
Yeah.
Depending on how the deal was structured. And then whatever's left kind of goes to the sponsor team.
Exactly.
So they can seem complicated, and they can certainly get more and more complex. Right. But the gist of it is just, hey, we're all just putting our money in this, and one guy's going to be the manager of it and going to take the lead on executing the business plan, and everyone's going to throw their cash into the bucket. And once you have enough cash, then you can't let anybody else in because you're good on that deal. Right. And then you're just looking at that one deal. And so, yeah, I love syndications for that reason. Just finding the right market you like, the right deal, the right asset class, the right team. Yeah. Somebody that you believe in, you trust, they're transparent, you feel comfortable with them. And that could be hard for a lot of entrepreneurs. Yeah. Because we're like control freaks.
100%.
And so it's more like I can do it better than that guy, or I don't want to and it can be a downside. Yeah. Like when you're trying to grow like wealth, or if you always have to be involved, you should have visibility and everything, but to just have to do it all yourself, it just creates it's too much work. Yeah. And so when you can find somebody who's a good partner, whether it's a syndication or a joint venture, like we were talking about, and you can trust them and setting it up where interests are aligned, where one guy's not making a ton of money if the other one loses.
Let's say you own a marketing company, right? You mentioned that before. You own a marketing company, or you own really any company, and part of owning a company is you need to have a website, right? That's a really important part of owning a company, is having a website. I'm going somewhere with this, by the way.
I'm listening.
Just because you are the business owner and you've got to have the website doesn't mean that you've got to go out and learn how to code in WordPress and build websites. There's people that are already great at that. And that, I think, is the biggest. That when you transition, though, it's this weird thing that happens when you transition as an entrepreneur into thinking about real estate. It's, I need to do it all myself. And it's either overwhelming and crippling and you don't take action, you don't do it, or it's like you jump in and you just try to do it on your own. And because real estate is so stable and so forgiving, and you can screw it up and still potentially make money, then it still works a little bit. I know someone who bought a house, spent 6 months renovating it. This is a guy that made $400,000 a year in his main business. So not as a salary, plus the value of the business. And spent 6 months renovating this asset. Sold it by the time you pay real estate commission, all that kind of stuff. Walked away with $40,000. Yeah. I'm like, dude, what you did was you paid yourself $25 an hour for 6 months. Is all. Like, you literally just bought yourself a low-paying job for 6 months with risk and your money tied up and all that kind of stuff. But the problem is that he made the money. He made $40,000. He walked away and it felt like it worked. And it's like, well, you're just not thinking far enough. Like, it didn't actually work as an investment. It worked as an extra job, like a side job, a side hustle, that if you just spent that same amount of time in your primary business, you probably would have made more money. If you just put that same amount of energy in your main business, you probably would have made more money than that.
And we've talked about this too. I think it was the National Real Estate Council of
Real Estate Investing Fiduciaries. They did a study back in 2020.
Yeah, it was around 4% of basically doing an investment with 100% ownership versus group investing or syndications. They actually outperformed the solo do-it-yourself, which was interesting to me. Yeah. Because I was I always thought if I'm not paying that guy, or if I don't have any partners, I get all of it, like I'm going to make more money, right?
Yeah. The annual return, it was, according to that study, a 20-year study, was 4.7% higher. The average annual return was 4.7% higher in group investments and syndications than in do-it-yourself real estate.
And I think that's what we were talking about as far as like why, right? You have access to larger assets. You got a team. You got everybody. In a perfect world, it doesn't always work this way, but if you're putting a large deal together, every single player in there should be awesome at that role. And if they're not, then they need to get out and get the right person in, right? But you can't do that when you have 100% ownership, because you're not going to be the awesome person for all the roles. Right. I might be awesome at finding deals and not that great at managing tenants.
Yeah. So I think the takeaway here is really, you have to think about real estate as an entrepreneur from the perspective of what do I want to give my time to and what skills do I think are most valuable overall for me to develop, and should I go learn how to code in WordPress so that my business can have a website, or should I just go find someone who's already really great at building websites? And that's kind of the same thing with real estate investing, is like, should I go out and learn how to do real estate and how to invest in real estate and all that kind of stuff? Sure, you should absolutely learn more and more about it, but do you need to learn how to execute on every aspect of it, or should you just plug in with a team that already knows how to do that and bring the part that you're already great at, right, to that team? And that's why they say real estate is best played as a team sport. So kind of we've touched a little bit on active real estate investing, and I know inevitably that even though we've talked a little bit about syndications and REITs versus joint ventures and do-it-yourself real estate, there's inevitably going to be some of our listeners that are still thinking, how am I going to juggle real estate with all my other stuff? And it sounds like a lot to handle. Aaron, I'd love to wrap up this episode by you just sharing a little bit about your journey and story in just a moment. But for me, when I got started investing in real estate, I was involved in doing my first fix and flip, like pretty much out of high school. And so I got bit by the real estate bug early, have been investing in various different ways in real estate for a long time. And I understand. For me, I, at that time, owned a landscaping business that I had started when I was 11, ended up exiting it at 26. But I did it really to keep my crews working through the colder months in North Carolina, right? And so that was the main reason that I did it, was, hey, now I can make a little bit of money here and pay my guys and whatever. So it wasn't really so much an investment as it was just a way to keep people working. But I realized, man, real estate is powerful, and I wasn't really juggling it in comparison to my other business. It was serving my other business. And so that for me was how I was able to juggle it. But a lot of people are not in a like kind of industry like I was at the time. As you've grown in this, I'd love for you to share a little more of your story as we wrap this episode up, of how you've morphed along the way and been able to juggle building a real estate portfolio that now, with Oak IQ, the business that you and I are partners in, is a $150 million real estate portfolio. You obviously didn't start there, right? So talk a little bit about your journey so that folks can see, one, that it is possible, two, the lessons learned along the way that they maybe could learn from your failures. And then three, I'd love for you to wrap up by how they could get connected with Oak IQ to learn more about how they could be a part of this real estate investing syndication world with us.
Yeah. So with real estate investing, you need to have cash, right? So you can get that through your active business, and then you can put it into real estate, or real estate can be your active business. And for me, that's just the industry that I'm in. And it also happens to be the place where I like investing. But it doesn't have to be that way. You can be the guy with the marketing firm, or the girl, or whatever we talked about earlier, that puts it into real estate, but it's the same concept. You have to have money to be able to invest into the real estate. And my journey was, I just started with houses, buying houses, flipping them, single family homes, not very nice ones. Then moved up to fourplexes, bought a fourplex on a street, lived in one of the units. I was newly married at the time, had 2 kids. We were living in a unit of a fourplex. And all of a sudden our rent went away. So we're like, okay, great. These other 3 tenants are paying our mortgage, taxes, insurance, and there was a couple hundred left. Like, they're even paying my phone bill. And so that enabled me to then continue to compound my savings. And then I ended up buying 6 more fourplexes on that street, and then just knocking on doors. They were all individually owned, so it was quite the journey of trying to get them all to close, and everyone had a different price they wanted. And but then I was able to like unify the whole package together, get it all closed, and then sold that off, and then bought a 92 unit apartment complex with a partner. Had to pull a guy in. It was a joint venture. And that was where I cut my teeth on like value add deals. It was old, it was low income. I didn't have any team. I was just figuring out how to do it all myself. It wasn't a mistake, because I just didn't have the team or have the finances to have a team, or I didn't have that structure. But looking back, I was like, wow, I think you have to go through that. I think every entrepreneur does. When you start your business, sometimes lonely, or just worse than it should be. Because you're just starting and you don't know how to do it. And that opened up the door then to syndications, where we began raising money from investors. Started with our next deal, which was around the same size, around 92 units, of friends and family. Then that opened up the door to launching a private equity firm, starting to raise money for larger and larger deals, and including 200, 300 unit Class A properties, doing ground up development. And all along the journey, just adding those team members as we went along. My first hire was like my executive admin, bookkeeper, then an asset manager, then a construction manager. Then we built an entire construction company that he's now over. Then the capital raising piece, the finance team, our CFO that we have, our analyst, all of our different people. As you progress along, you start, now we have our marketing division, and it's just, when the time's right, just any business, right? You're like, okay, we need to hire this person now and grow that part of it. And that's been my journey in real estate. But I guess the takeaway is everything that I just said is how it works in any business, regardless of industry.
Absolutely.
So if you want to be active in real estate, like we were talking about, and manage it all, and then you have to do what I've done, which is work in real estate.
Or the alternative is you want to reap the benefit of someone who's been through that growth trajectory, got that experience and expertise through grinding, through figuring it all out along the way. And then you can plug into an already established real estate investment strategy, philosophy, and thesis that is well-founded by experience. And I think a lot of entrepreneurs, that's a better option, because you get to, we always say, either learn from your own failures, or better yet, learn from someone else's failures and learn from someone else's successes. And so why not benefit from someone else's decade of various failures and successes that got them to this point, and now you can jump in and just be a part of where they are now and bypass that decade in your own real estate investing journey. And to me, that's the smart move.
Yeah. And everything you said about how hard it was or whatever, that's any entrepreneur in any industry.
Yeah.
So to say, agreeing with your point, why go through that meat grinder of brain damage in a different industry that's real estate?
Yeah.
When you can go into that passively and potentially make 4%, 4 to 5% more anyways.
Yeah.
And
absolutely.
You can just, we always talk about this, about staying in your lane. And I'm constantly trying to it's so easy to get pulled in different directions. I can do that or this, or no, I'm only good at 2 things.
Yeah.
I just have to try to stay in there and that's how everyone will be that's how everything will be most successful, is if everyone's doing exactly what they're supposed to be doing.
Stay in their lane and owning their exit.
Yeah.
I think it's a good place for us to wrap it up.
I think so.
So I think our takeaway from this, the last little piece, is stay in your lane, own your exit. Today, we've talked a lot about real estate investing. Listen, if you're interested in learning a little bit more about connecting with me and Aaron in our primary business, go ahead and visit oakiq.com. That's oak like the tree, iq.com. And check us out. We've got a lot of free resources on there, a lot of free educational material. We've got a webinar on there called Exit to Freedom that just talks about our strategy for helping entrepreneurs invest in real estate. Some other things on our resource page. You can look at our portfolio page. Just explore around and reach out to us if you're interested in learning more. That's all we got for now. Thanks everybody for joining us on Own the Exit. We'll see you next time.
Thanks everyone. See you next time.